That's a good lead into our next guest. A year after Lehman fatally collapsed and took the markets down with it, we are looking back to see how great an effect the bank failure had on the then coming crisis. Nouriel Roubini is chairman of RGEmonitor.com. You know him, of course, as the professor of economics and international business at NYU Stern School of Business. Professor, good to have you back.
Good morning, Carl. Pleasure being on your program again.
Your thoughts a year later, and with that, you can take it in any direction as to whether or not they should have been saved, whether or not saving them allowed us to later on save other bigger players. A lot written over the weekend about the lessons and mistakes that were made.
Well, the first observation is there is this interpretation that if we had only saved Lehman, things would have been fine, and the cause of this meltdown and global economic and financial crisis was letting Lehman go. But I think people forget that by the time Lehman was gone, the housing recession had started 2 years before. The actual economic recession had started the previous November, where the severe financial crisis, 300 plus non-bank mortgage lenders had gone out of business, sieves and conduits had gone out of business, Bear Stearns had collapsed, Fannie and Freddie had collapsed, Merrill Lynch had the same problem as Lehman, Bank of America and Citigroup had hundreds of billions of dollars toxic assets, finance companies were in trouble, the interbank market had seized the year before, so we are already in the middle of a very severe crisis. So saying if we had bailed out Lehman, everything would have been okay is just nonsense. It's not understanding the difference between cause and effect. Lehman was a symptom, an effect of the crisis. It was not the cause of the crisis.
Right.
And if we had bailed out Lehman, we'd had to bail out everybody else.
Did allowing it to fail, though, give regulators, the administration, the political will, right, the panic, to put into tools, to put into effect tools that would later be useful?
Yes, certainly a wide variety of unconventional monetary and credit policies and rescue of the financial system were implemented, some of them before Lehman, some of them after Lehman. The support and the backstopping of the financial system has been a commitment of at least $12 trillion of resources. 3 out of 12 have already been spent. Is liquidity provision, recapitalization, guarantees, insurance, you name it. But many of these things occurred well before Lehman. Many of them occurred after Lehman.
Do you feel better or worse than you did pre-Lehman? I know at the time you said that a depression was not an altogether impossibility, right?
Yeah.
You think that's been taken off the table, but we've replaced it with an unimaginable amount of debt.
Yeah, that's one of my concerns about the economy ahead. That's why I see the risk, first of all, of a U-shaped recovery. There's going to be anemic below trend, and then even a risk of a W. Why? We still have all the leverage of the private sector, highly leveraged household sector, highly leveraged corporate sector, highly leveraged financial system. And as a way of socializing some of the private losses, we have socialized them, and now there is a massive releveraging of the public sector. And that's why I see a situation in which many agents in the economy cannot borrow as much, cannot spend as much. There is not going to be consumption growth. There is not going to be as much capex spending because of this burden of having to reduce the leverage by saving more. And because of that, the recovery is going to be at best dynamic for the next couple of years.
But you make deleveraging sound like a bad thing. We need to delever, don't we? We just need it to be spread out over time so we can handle it all.
Absolutely. The U.S. consumer has to deleverage, means they has to save more and spend less. If consumption growth that is 70% of GDP is going to be anemic below growth of the economy, then we're going to have a growth of the economy is not going to be as high as otherwise. So that's part of the problem we're facing. We need to deleverage, we have to save more, but because of that, the growth is going to be weak for a while.
Nouriel, you're a tough critic, and if I had been Bernanke, I would have been worried if they told me you were going to write something about whether he should be reappointed or not, and now you were positive. He has been reappointed, so I assume that you think he was instrumental in the whole crisis. I know you feel that way because I read the piece. How about the stress test and Geithner and not nationalizing the banks? You know, Nassim Taleb probably takes the opposite tack, that maybe we should have done more in that regard. Do you think that was all handled properly?
Well, on the first issue, I criticized Bernanke for many of the mistakes he made before the crisis, not understanding the nature of why this crisis will come severe, but I gave him credit for the fact that his actions had led to avoiding another Great Depression. That's why I supported his reappointment. On the issue of the banks, let's be realistic about it. 350 non-bank mortgage lenders have gone out of business. More than 100 banks have gone out of business. The banks that are on the list of the FDIC that are in trouble are already 400. So at the end of the day, we might have over 1,000 financial institutions, and even some of the big ones like Fannie and Freddie, Bear Stearns, AIG, Lehman have gone bust. So this is a severe financial crisis. Now, how would they have dealt with the issue of the banks? My view of it is that still many losses have not been acknowledged. There is now massive forbearance. For example, $2 trillion of commercial real estate is in trouble. You're going to have default rates of 30%, but now the regulator have said forbearance. Let's pretend that these assets and loans are worth face value, and we're going to wait. And eventually, there's going to be trouble for regional banks, for smaller banks. So if you think about it, subprime went to near prime and prime. Now it's commercial real estate, credit cards, auto loans, student loans, leverage loans, industrial and commercial loans, corporate bonds, muni bonds. All these losses slowly are adding up. It's going to be a death by 1,000 cuts. We're not going to have another blowout like Lehman because we decided that nobody is systemically important is going to be allowed to collapse again like Lehman. But the financial system is severely damaged. It's not just the banks. Most of the shadow banking system has completely disappeared. There is no securitization. There is no credit growth. So how the economy is going to grow? Let's recognize that things are much better than a year ago, of course, and I credit the policymaker with their strong actions, but there is still huge amount of damage in the financial system, in the credit markets, and in the real economy.
All right, so, but, you have a question?
No, I agree with Dr. Roubini. The commercial real estate problem is an enormous problem, may in fact be bigger than the subprime problem was. And, you know, we're not out of the woods on the residential because of all the interest-only mortgages which have to reset. What do you think the effect of that's going to be?
Absolutely. Right now, delinquencies are rising from subprime to near prime and prime. There are the interest rate-only mortgages. There is now, by the way, a moratorium on foreclosures. And because of that, the excess supply of homes on the market has been limited, but eventually this moratorium is going to disappear. And people look at the data, they see a massive increase in the supply of existing homes that are going to come in the market in the next 6 to 12 months. So while the quantities in the housing market now have stabilized because they fell 80% from the peak, demand and supply, the gap between supply and demand is so huge, you could stop producing new homes for a year to get rid of the inventories, and about 1/3 of all existing home sales are distressed sales, for short sales or sales of foreclosed homes, and that's going to increase. So the price adjustment, in my view, is going to continue for another year, and on a cumulative basis, 40% reduction in home prices sometime next year from the peak. That means that half of the people that have a mortgage are going to be underwater with negative equity in their homes. So that's what we're facing right now.
You're talking prices going down at least another, what, 15%?
I would say 12%. They've gone out about 28. I'd see them cumulative being down by 40% sometime next year.
You talk about a death by 1,000 cuts, Nouriel, in that we're not going to have another blow-up like Lehman. Why is that? Why don't you believe we're going to walk in here some morning and face some explosive event, an overnight collapse of the dollar? Are you saying that's not going to happen? That's off the table?
Well, you know, extreme events can occur. You have to assign probabilities. What I'm saying is that last November, the G7 said clearly we're not going to let anybody that is systemically important to collapse in a disorderly way, and they've not allowed it. They've backstopped the financial system in 20 different ways, and therefore the blow-up of a major institution right now, even if it were to be insolvent, is unlikely. That's not going to let happen. Now, on the dollar, of course, there is a risk that if we're going to use the inflation tax as a way of wiping out the real value of our public debt and as a way of dealing with the problem of the debt deflation in the private sector, if this was the route we're going to take down the line, eventually there could be a collapse of the dollar. That's why I'm worried about the double dip, that runaway fiscal deficits that are not being addressed are going to lead to the temptation of using monetization of this deficit that is eventually inflation. Then in that case, the dollar could collapse. But again, you have to assign probability. To me, it's still a low probability scenario, but it's a risk that we have to be aware of.
Nouriel, thank you. Oh, you go ahead.
No, please.
No, well, then you read this.
Okay. Nouriel, it's good to see you.
A pleasure being with you.
Yeah.
Thank you.
You sure?
No, yeah, I'm positive. Even though you were on, would you do the Today Show?
No.
Yeah, you did.
He did.
Yeah, you did.
When we come back, the Fed and the financial crisis, the Treasury and the central bank